Chewy stock surged over 30% last week after Roaring Kitty, aka Keith Gil, revealed a $200 million position in the company. At the latest price, the online pet business now has a market cap of $10.9 billion. With $1.1 billion of cash and no debt on the balance sheet, the enterprise value is $9.8 billion. Revenue over the last 12 months comes to $11.2 billion, with $84 million of net income, $256 million of adjusted ebitda, and $268 million of free cash flow. So Chewy stock is now valued at 130 times earnings and 37 times free cash flow. At an investor day last year, Chewy unveiled a plan to reignite growth and get to a long-term adjusted ebitda margin over 10%. Such a margin would mean strong earnings growth for Chewy and a significant increase in the stock price. And so far the plan seems to be working. Chewy has grown its recurring auto ship revenue, introduced advertising and sponsorships, expanded into Canada, and begun to open new offline veterinary clinics. These clinics can drive new revenue as well as awareness for the Chewy brand. True to form, adjusted ebitda margin took a big step up in the latest quarter, hitting 5.7%, a significant improvement. If this performance holds, Chewy could deliver over $500 million in free cash flow this year. That's a lot considering the current valuation. And Chewy's stock, which has rallied 60% since May, should have more upside ahead. However, there are some reasons for caution over the latest figures. The first is that Chewy still isn't experiencing user growth. Revenue may have gone up, but the number of users on the platform declined again to 20 million. Meanwhile, website traffic, as recorded by third-party data service SEMrush, appears weak. Without underlying user growth, it's going to be hard for Chewy to grow its top-line sales, which is why management expects only 4 to 6% growth this year. Second, although Chewy's margins were up in the first quarter, they are expected to move back down again as the year continues. Chewy's operating expenses will increase in the back half of the year, taking earnings down with it. That's especially negative because Chewy still reports a hefty amount of stock-based compensation, over $250 million over the past 12 months. Based on a simple discounted cash flow model that expects 5% revenue growth for 10 years and a free cash flow margin that gets to 8% in year 4, I estimate an annualized return from Chewy's stock in the region of 11.1%. That's with a 10% discount rate, 2.5% terminal rate, and including some dilution from stock-based compensation. That return isn't too bad when you consider the assumptions. 5% revenue growth is on the low side, and Chewy can do better than that, particularly if the pet industry puts in a strong recovery. Chewy is up against big retailers like Amazon and Target, but the company's business plan does make sense, and the stock can provide good returns so long as it gets back to growth. That's why I give the stock a bullish rating, but these are my personal opinions, not financial advice, and I hold no position in Chewy. For more investing videos, make sure to visit my website at 3minutebreakdowns.com. Thank you for watching.